The new year is going to be here before you know it, but there is still plenty of time to implement a plan and impactful strategies going forward into 2026. From retirement and tax planning to Medicare strategy and leaving a legacy for your heirs, in today's video, I'm going to cover some of the most impactful strategies that I believe you can implement before the start of the new year. And be sure to stick around to the end where I'm going to outline the exact savings strategy that I use year after year to help build my foundation. Today, I'm going to show you exactly how a Roth conversion ladder works, how it could potentially allow you to access retirement funds before the age of 59.5, and how crucial reporting properly is to ensure that you don't slip up and make a mistake that could cost you tens of thousands of dollars. Now, many of you might assume that the only way to access retirement funds is to wait until the age of 59.5, or you could get hit with taxes and penalties, which could become a hindrance should you decide to retire before that magic age. But there is a completely legal, IRS-recognized strategy that could allow you to access these funds, and that is with the Roth conversion ladder. At its core, a Roth conversion ladder is moving certain amounts of money over time from traditional pre-tax 401k, 403b, or IRA accounts to Roth accounts. Once inside the Roth, those dollars can be accessed tax-free and penalty-free, providing they reach the 5-year holding period. And this isn't about cutting corners. It's about working within the rules that are legitimate in order to create an additional layer of flexibility for your retirement plan. Although there's a lot of jargon around this, the explanation is rather simple. Contributions to the Roth are money that you put in. Conversions to the Roth are money that you shift from a pre-tax account to the Roth account. And earnings on the Roth is anything that grows above and beyond these limits. And separating those three terms and having a very distinct understanding of what they are can potentially help you clear up any confusion that could come with this strategy. Let's picture the ladder idea in practice. Each time you make a conversion, that particular conversion of dollars from a pre-tax account to a Roth account starts its own 5-year clock. After 5 years passes, that particular amount in which you converted becomes accessible, tax-free, and penalty-free. In the case of a ladder, say year 1, you convert $50,000, which has its own 5-year window, and then year 2, you convert another $50,000, which starts its own 5-year clock, and so on and so forth. And in doing this over time, you essentially create rungs of money in which you have access to theoretically before you reach the age of 59.5. What I find interesting is that the flexibility that comes along with this strategy tends to have fewer restrictions than other retirement strategies that you might consider implementing over time. And unlike Roth contributions, there is no income limit when it comes to conversions, so in theory, you can convert any amount that you want at any time over the course of years or at once. But like anything, there are trade-offs that come with this strategy as well. And the fact of the matter is, every dollar that you convert is a dollar added onto your income for that particular year. So with that, it can be helpful to speak with your tax professional and your financial professional to gain a full understanding of all sources of income now and for the foreseeable future to see if these Roth conversions might be right for you. I will say from an opportunity standpoint, these Roth conversions could be particularly timely during a market downturn or correction. In these instances, you might have the opportunity to move money from your pre-tax account to your Roth account while investment prices are depressed. And when they eventually come back, if they do, they will experience the recovery inside of a tax-free account. And while the real payoff might not be immediate when doing these conversions, in doing so, you are creating flexibility for yourself, and you could experience compounding growth over time, again, which ends up being tax-free. But here's where things could get tricky. As I mentioned earlier, if these conversions take place over a series of years, they each start their own 5-year conversion clock. So, if you're not in tune with this, misunderstanding the timing could result in unfortunate mistakes and tax consequences. This is one of the reasons I feel that starting as early as possible, providing it makes sense for your situation, can be very important. For example, if you expect to leave the workforce at age 50, but you only start those Roth conversions at that point in time, you'll have to wait until at least 55 years old to access that first rung of money. To avoid falling into this bind, we like to ensure when we're reviewing with clients that if they're going to do so, that they have access to ample liquidity from other sources leading up to and through this conversion ladder. In certain cases, this could be having ample cash on the sidelines or something like a non-retirement oriented brokerage account. It's also important to remember this is essentially a dual balancing act. You have to balance having liquidity now and for the future, in addition to the fact that every time you make the conversion, the IRS gets their tax cut up front. So, when you look at things from more of a holistic perspective, it can certainly be important to consider the fact that you might want to make these conversions over a period of years, and again, having access to liquidity during those years, not only for living expenses, but also to pay the potential tax with making these conversions. And while understanding when your conversions become accessible, something that retirees often overlook is how the IRS judges which buckets of money within the Roth you're pulling out in which order. To this point, they don't let you pick out where that money comes from. And the order is as follows. The first money out is your contributions. The next money out is any conversions. And the third rung of money that comes out is any gains on top. And this order definitely matters, because while contributions might be able to be pulled out immediately, and conversions can be pulled out after the 5-year window is met, any earnings growth that's pulled out too early could end up facing taxes and penalties. To clarify these buckets again, contributions are any monies paid into a Roth with after-tax dollars. Conversions occur when you shift money from a pre-tax account to a Roth account, and earnings are any money that is made on top with the investment growth over time. Now, something that I found to be particularly useful over time is having a full understanding and record keeping of your basis, your contributions, and your conversions. And while your investment statements might show the distributions made in a particular year, they don't always break out the money based on contributions, conversions, and growth. Some folks might choose to use tax software in order to create a ledger for themselves, and others might simply use a spreadsheet. I find when this tracking is consistent, although it could require a little bit more work up front, it could end up preventing headaches on the back end. In doing this, you could end up gaining a better understanding of when your future money is available, when those contributions were made, when they can be accessed, when the conversions were made and when they can be accessed, and what monies on top are growth and when they can be accessed. And this means in practice, something that might be considered an early withdrawal can be taken out without taxes and penalties if done correct, as you're following the IRS rules. The best part is, those funds that you don't touch have the potential to experience compounding growth in a tax-free manner over time. But before you can fully rely on this system, there's another thing I want to hit on. Even if you fully understand the withdrawal order with precision, the fact of the matter is each conversion can add taxable income to your income for the year. And in order to avoid these tax bombs, you need to make sure that you're planning carefully. These common mistakes could result in getting pushed into a higher tax bracket, potentially having a larger portion of your Social Security taxed, or even getting hit with IRMAA surcharges. Because the fact is, conversions don't happen in a vacuum. And every dollar that you move from your traditional pre-tax accounts to your Roth account add to your income for the year. If you end up converting too much in a lump sum, it could propel you dramatically higher as far as tax brackets are concerned, which could, in theory, potentially wipe out part of the benefit that the conversions are for in the immediate. Think of it this way. Your income stacks through each tax bracket moving higher. And the more you move up on that tax bracket list, the bigger slice of your money is taken away. So, adding conversions as income, on top of potential dividends, capital gains, Social Security, or pensions, could propel you dramatically higher. And although it's not always possible, we do try to consider when working with clients to aim to move the money over the course of several years, as opposed to making 1 or 2 large conversions up front. A very general rule of thumb that I take into consideration is understanding what the headroom is before you hit the top of your intended bracket and only converting that amount. We refer to this strategy as bracket filling, and the general thought behind it is not crossing any tax brackets that would push you significantly higher as far as your taxable situation is concerned. For example, in 2025, the 24% federal tax bracket allows a single filer up to $197,300 in income for the year. So, if you have $120,000 from other income sources, you have about $70,000 that you can convert before popping up into the next tax bracket. On the other hand, if you don't have a good understanding of this, and you chose to convert, say, $300,000 in one shot, you could end up propelling significantly higher as far as tax brackets are concerned and facing taxes that you did not intend on. This, too, can be a bit of a balancing act, because we're not looking solely at the size of one's pre-tax retirement accounts, but we're also looking at the lifetime tax liability and how we can best spread that out over time. That's why it can make sense to coordinate your Roth conversions with all other sources of income. Building a ladder based on steady pacing, for example, if you intend to convert a sum of $500,000, consider moving that money over the course of 5 to 10 years, instead of over the course of 1 to 2 years. I will say, there are a handful of other caveats that come into play when planning for these scenarios and the pros and cons of Roth conversions. One of them being legacy planning. Beyond just the dollars and cents that come with the conversions and your own personal situation, taking into account what type of legacy you want to leave behind for your heirs. Converting pre-tax funds in the immediate could allow you to pay the taxes now and potentially leave a tax-free bucket of money to your heirs at the time of passing. In addition, in preparation of required minimum distributions for yourself at some point in time, doing this Roth conversion ladder could allow you to potentially lower your lifetime tax liability. Converting portions of your pre-tax money now and through the course of time prior to reaching RMD age could allow you to lower the overall value of your pre-tax accounts, which could in turn lessen the blow when it comes to your required minimum distributions. And thanks to technology, there are a plethora of tools at our fingertips that help us when we're trying to weigh the pros and cons of making these choices. This is not necessarily a one-time set it and forget it strategy, but more so something that requires annual planning in working with your accountant and tax professional, in addition to your financial professional, to have an understanding of how these conversions could pair with your sources of income each year moving forward. And although this strategy might not make sense for everybody, I have seen multiple times where the payoff ends up being substantial. Creating a predictable pattern of potential tax-free withdrawals, lowering your lifetime tax liability and smoothing out the required minimum distribution process, in addition to potentially leaving tax-free money to your heirs, are all potential benefits of these Roth conversion ladders. Today, I'm going to show you 4 specific strategies that I have seen wealthy clients use over time as far as their charitable donations are concerned, not just purely out of generosity, but also for tax planning purposes for today, as well as leaving a legacy to their heirs tomorrow. Over the course of my career, I've had the pleasure of working with hundreds of families as they move through wealth transitions over time, and they tend to have a few tools in common. Using one's wealth for both purpose and with efficiency, which raises the question, why do some of these wealthy retirees give so much money away in the first place? I always like to give the benefit of the doubt, and I would say that the driving force in many of these instances comes from a place of generosity, caring, and the want to make change. But with that, we can't count out the fact that in many situations, it's also a deliberate planning strategy as well. Herein lies the key of what I've seen in having the opportunity to handle some of the challenges that could come along with building significant wealth. Instead of worrying solely about income in retirement, we tend to shift the focus to things like tax planning, estate planning reviews, and passing money to the next generation. And this is where giving in some instances can take on a whole new role. Not only do you have the ability to potentially make an impact for causes that are important to you, but you also could create a tax efficiency strategy over time. For example, every dollar shifted in some way or another is the potential dollar that doesn't get added to the federal state tax limit when you do pass those assets to the next generation. That tax, in some cases, could end up being as high as 40%. So if you take the opportunity to move over, say, $500,000, that could end up being a savings of about $200,000 over time. Of course, it's important to keep in mind that these dollars would have to be above and beyond the federal and state exemption thresholds. When framed this way, giving can seem more of like a moral cause. Every dollar transitioned above and beyond those particular limits could end up being a dollar saved from erosion by taxes. Consider a hypothetical retiree that decides to make the choice to give money away in a substantial portion year over year. Not only are they supporting causes that might be important to them, which can include things like a hospital or a school system or even a local foundation, but they're also shifting dollars away from their taxable estate, which could potentially get hit with taxes later on in life. Over time, this could end up allowing them to pass substantial money to their heirs in addition to supporting causes that are important to them. These scenarios tend to be less about just casually writing checks and giving things away, and more so about a structured financial plan. And one of the tools that could be considered to help carry out this strategy is that of a donor-advised fund. Picture being able to lock in a tax deduction in a year that you really need it, but having time, potentially years or decades, to figure out which charities you want to support and allow them to benefit from your contribution. That's a function that a donor-advised fund can provide. Retirees might use this option to match unpredictable income years, where they're able to get a deduction and put money away, in addition to not having to rush and decide which charities they're going to give that money to later on. Let's say you experience a larger than normal income year, whether it's selling highly appreciated stock or even the sale of a business. Making a contribution to a donor-advised fund could allow you to capture that deduction immediately. It's important to note here that as far as tax rules are concerned, any money given to a donor-advised fund is irrevocable and cannot be taken back. At the same time, you do retain the ability to end up making the recommendation for where those funds should go. However, also important to note, the sponsoring organization of the donor-advised fund has the legal say in where the money ends up being contributed. Another potential advantage that I would take into consideration here is donating highly appreciated assets. Imagine purchasing a stock for $50,000 years ago, and it's now appreciated to a position of about $500,000. If you decide to sell it at this point, the entire $450,000 gain would be subject to tax. However, by transitioning that to something like a donor-advised fund, those capital gains end up being taken on in a tax-free manner when sold by the fund, and you are able to take the full deduction up front. It is worth noting, however, these deductions and contributions do come with limitations. Generally speaking, contributions made via cash are generally deductible on your adjusted gross income by up to 60%, but contributing long-term appreciated assets over time are deductible up to 30% of the value. Any unused deduction in the current year can be carried forward for up to 5 years, and this can be a meaningful impact on your overall planning if you think that you could have high-income years going forward. Being that everybody's situation is different, it could be useful to speak to your tax advisor for your particular plan. In addition to this, I do often find that folks that are philanthropically inclined do have several causes that are important to them. With that, by making that one contribution to the donor advised fund, you can then use that as the sole source where that fund will then allow those distributions to go out to the multiple causes, as opposed to having to cut multiple checks yourself. This can consolidate record keeping for you and allow you to keep your books and records a lot more neat and clean. I will say, I've also seen the emotional importance of making these contributions over time. When you have situations where a parent or a grandparent might include their child or grandchild in deciding which grants should go to which foundations. With that, what could start off as a simple tax strategy could end up evolving into a way for your family to come together and understand how to steward wealth responsibly. Some quick caveats to be aware of. Again, there could be administrative costs which could differ based on the financial institution sponsoring the fund. In addition to that, remember that all contributions are made irrevocably. All things considered, donor-advised funds can certainly be one of the more versatile ways to balance your charitable giving in addition to your tax planning. But charitable planning doesn't just stop there. It's not always a situation where we encounter somebody having a higher than income year due to sale of highly appreciated stock or a business. It could be dealing with mandatory withdrawals from your retirement account, also known as required minimum distributions. This situation presents a very different planning opportunity, which also could cause for a completely different strategy. In the event you're unaware, a required minimum distribution is where a retiree reaches a certain age, for 2025 that age being 73 years old, and you are then forced to take a certain percentage of your pre-tax retirement accounts each year thereafter, whether you need the money or not. This is where a QCD, or qualified charitable distribution, could come into play in your planning. A QCD allows IRA and pre-tax account owners to take a portion of their money after reaching the age of 70 and a half and distribute that to a qualifying charity. The distribution still counts towards satisfying their RMD for the year. However, it's not added to their gross income. In 2025, the QCD limit is $108,000 per IRA owner or $216,000 per couple filing jointly. To see how this works in practice, imagine your RMD is $100,000 for the year, but you already have your living expenses covered by other sources of income. If you accept that $100,000 distribution directly, that now gets added to your income for the year and could end up increasing your tax bracket or other costs associated to your modified adjusted gross income. In contrast, by giving that $100,000 to a qualifying charity through a qualified charitable distribution, you're able to satisfy your RMD, but that income never hits you. Unlike ordinary charitable deductions, which only reduces income once that withdrawal is reported, the QCD takes that withdrawal away from your situation entirely. This lower AGI can potentially ripple across multiple pieces of your financial plan, whether it ends up resulting in something like less of a portion of your Social Security being taxed, maybe you receive lower Medicare premiums, or maybe you don't end up hitting the phase-out limits for certain state deductions. With that, there are limitations to keep in mind as well. QCDs need to be made as distributions directly to public charities. They cannot be made to donor-advised funds or private foundations, and it's very important to make sure you route this correctly, or it could end up eliminating the situation for yourself entirely. The IRS also specifies that you cannot receive anything in turn from making that QCD, so this must purely be a true donation. Because these requirements are strict, it could be worth your time to speak with your accountant, your advisor, and the custodian of your IRA or pre-tax account before making these choices and actual withdrawals. And while QCDs can seem as a streamlined approach for planning on an annual basis, Sometimes greater levels of wealth require greater timelines in thinking, where we have to think about transitioning wealth in a multi-year process. And one way that retirees might do this is considering charitable trusts, a vehicle that can help balance your family needs and goals in addition to your charitable and philanthropic values. Two structures which I encounter most commonly are the Charitable Remainder Trust and the Charitable Lead Trust. Put simply, a Charitable Remainder Trust allows one to transfer assets into the trust. A structured system of payments or dividends is given from that trust to a specified beneficiary for a certain period of time, and the money that is left over and remains will then be given to charities of your decision. And a Charitable Lead Trust works in just the opposite way, where it allows you to transfer a sum of money. Structured payments over a set period of time are made to a qualifying charity, and any money left over at the end of that period is given to the beneficiaries of the trust. At first glance, this might seem complex, and you might think that trusts are only for the ultra-wealthy. And while these trusts might come with slightly larger expense as far as legal fees and administrative fees are concerned, they could end up being a better option if you are considering more than just a one-time donation. Let's take a look at how this works in practice. A retiree can choose to utilize something like a highly appreciated stock position or real estate. And instead of selling that in your own name and triggering capital gains tax, the sale can occur within the trust where the capital gains tax is tax-free. After doing so, not only can you reinvest the proceeds within the trust, you get an immediate deduction for the fair market value of the assets on the date the assets were transferred into the trust, and you can now create a stream of income, whether for yourself, a beneficiary, or charity, depending which trust structure you use, and then the money passes on after that remaining time is over. It's important to note that there are some caveats in choosing to go either of these routes. Number one, potentially having the willingness to commit significant capital. Number two, carefully drafting legal documents. Number three, potential for additional administrative fees. And number four, choosing a trustee for the trust. And while financial due diligence could be essential into making these decisions, it is important that you can't count out the generational impact that you could have in including those heirs and the ones that are closest to you in making these choices. Opting to intentionally build a legacy by design rather than by default. And if you're considering any of these strategies, it could be worth getting your entire team of trusted professionals together to have one consolidated conversation. Today, I'm going to break down what I would consider to be the two biggest changes coming for retirement savers ages 50 and over, and what they need to know about the upcoming catch-up contribution changes to Roth. We're going to dive into the limits for 2025, what the enhanced and or super catch-up contributions are for those of you between ages 60 and 63, in addition to why this Roth catch-up contribution change for 2026 could end up putting a damper on your plans to contribute to your 401k. My goal here is to arm you with the information to make an educated decision when it comes to your planning and not get derailed at what could be a critical time period for you saving. Now, for those of you not aware, the catch-up contribution started back in the year 2002 with an extra $1,000 catch-up contribution for retirement savers ages 50 and over, and that number has steadily increased over time. And while some might say the consistency has been powerful, the simple framework is changing. Through the passage of the Secure Act 2.0, Congress has put into place two major changes for the retirement space, including, in 2025, for retirement savers ages 60 to 63, the super or enhanced catch-up, in addition to rules starting in 2026, where any high-income earners above a certain threshold will have their catch-up contributions routed to Roth. Now, why does this matter, you might ask? Because what could have been considered a simple set of rules prior is now being split into two different factors based on your age as well as your income. To ground this in some real numbers, let's look at how this works. You're probably already aware for the catch-up contributions as far as 2025 are concerned, but if you're not, for those over the age of 50, in addition to their regular contribution max of $23,500, they can make an additional contribution of $7,500 for a total of $31,000 for the year. And for those of you between ages 60 and 63, this catch-up situation goes even higher. When Congress originally passed Secure Act 2.0, the initial start date was set to take place in 2024. But the IRS quickly realized that record keepers and payroll administrators were not fully equipped and ready to handle these changes. And this ultimately turned into a 2-year administrative delay, which pushed the rules back, set to start January 1st of 2026. And for savers, all of this could end up signaling a strategic shift in your planning. This new playbook includes narrow age windows, adjusted inflation increases, and for some, a 2026 Roth mandatory catch-up contribution for those earning $145,000 or more. With regards to this enhanced or super catch-up for 2025, the regular contribution ceiling is $23,500, the catch-up contribution for those 50 and over is $7,500, and for those of you falling between ages 60 and 63, you can now contribute 150% of what that catch-up contribution limit would be. So for this year in 2025, your limit is $11,250. Add up all these numbers, and you have a contribution allowable limit of $34,750 for 2025. Let's consider a practical example here. A 61-year-old worker is able to contribute all of the limits that I just explained above, bringing their total sum for the year of 2025 up to a contribution of $34,750. Compare that to a coworker who is age 59, and they can only contribute up to the maximum allowable amount of $31,000 for the year. The dollar gap here is $3,750. And if you were to do that over the course of ages 60, 61, 62, and 63, the total additional contributions could tally up to $15,000. Compound that with the potential for investment returns and employer match, and you could find yourself in a completely different ballgame. These new limits, in theory, could be useful for those of you who might have gotten started later on in life in saving, or had the opportunity that a more expensive time in life has now passed and you can put those extra dollars away. But either way, anybody who is saving for retirement, in my opinion, could benefit from considering these rules. Now, let's take a look at this Roth catch-up rule set to take place January 1 of 2026. The rule in plain terms states, if your FICA wages from the year before equate to $145,000 or more from the employer sponsoring the plan, you are now forced to make catch-up contributions as a Roth contribution. This income test is not based on your modified adjusted gross income, it's not based on your household income, and it is not based on your combined wages. It is solely based on your FICA wages from the employer sponsoring the plan in which you're contributing to. This threshold is also adjusted for inflation over time. So theoretically, that number should rise as you get older. And this distinction can be crucial because it could give different outcomes for workers making similar amounts of income. Consider two individuals, each making $150,000 a year. Employee 1 earns $150,000 of FICA wages all from one employer. Employee 2 earns $90,000 of FICA wages from that particular employer and $60,000 in additional self-employment earnings. Although both workers end up having about $150,000 in wages for the year, only $90,000 of employee number 2's FICA wages are captured because that is the only amount that comes from the employer sponsoring his particular plan. The caveat here, since employee 2's FICA wages fall below the $145,000 threshold, they still have the freedom and flexibility to elect whether they want to make pre-tax or Roth contributions when it comes to their catch-up. So, in simple terms, two individuals with similar income could be treated completely different from a planning standpoint. Also important to note, these new rules regarding Roth contributions are only effective as far as the catch-up contributions are concerned. You're still able to make pre-tax or Roth contributions for any dollars up to the limit of the catch-up for that year. This means that high-income earners can still elect pre-tax treatment for their regular deferrals. It's also worth noting that any contributions made on a Roth basis prior to reaching that catch-up limit can count towards your catch-up contributions. Having an understanding of this detail can play an important role in remaining in compliance with your contributions for the year. In addition, a practical outcome to this situation is that higher income earners that have been making those catch-up contributions historically could end up facing higher income on the year. In theory, for example, a high income earner making $160,000 a year contributes $7,500 of their catch-up pre-tax. However, with the new rules, that $7,500 would need to be made on a Roth basis, which in effect would increase their overall income on the year. Despite the fact that this could change cash flow in the immediate, there is a potential for long-term growth in retirement savings. In addition to the fact that the Roth money will grow tax-free over time, and over the age of 59 and a half, provided you have held that money for 5 years in the Roth, that money can be withdrawn tax-free without penalty. This next caveat, which could end up throwing a little bit of a wrench into your planning, is plan design, which could end up making things working more smooth or potentially acting as a roadblock. While the Roth mandate might seem simple on paper, whether or not you can actually use this benefit is determined by the fact of your plan allowing for Roth contributions or not. A saver's intentions might not be as impactful if they're not able to have these contributions set up properly. And while truth be told, the retirement landscape has shifted throughout the course of my career. Whereas many more plans nowadays allow for Roth contributions, there are still some out there that don't. And for participants in those particular plans that don't allow for Roth contributions, if your wages do exceed that $145,000 FICA limit, unfortunately, you're not going to be able to make catch-up contributions for that year. And for plans that do currently allow for Roth contributions, the design can dictate a lot. From what I've seen, there are a few common approaches to this situation. The first being the separate catch-up contribution election, whereby you elect to make any contributions that act as a catch-up at any point in time made based on a Roth contribution. And the second being the deemed Roth catch-up, or the spillover catch-up contribution, whereby any contributions made above and beyond the limits are automatically made on a Roth basis. Understand that everybody's plan is different, so having a conversation with your plan administrator could give you the information that you need to make informed decisions about your strategy. When approaching this situation with the folks that we have these conversations with, my first goal is to understand the design of their plan. Having the knowledge if their current plan allows for Roth designations and if they have a plan in place come January 1, 2026 of how they're going to handle the catch-up contributions. Having the answer to this question allows us to understand how we're going to plan proactively and where we could end up going in the years to come. The second step is where we determine if the employee is considered a high-income earner under the new rule. If they are, in accordance with the new mandate, their catch-up contributions must be made on a Roth basis. And if they're not, they may still have the flexibility to make those catch-up contributions via pre-tax dollars. The third step is relevant if you're between the ages of 60 to 63, and if you're going to go for the enhanced or super catch-up. And the fourth step is where tax planning comes into play. In understanding that anyone making catch-up contributions who's considered a high-income earner would have those contributions made on a Roth basis could ultimately impact their income for the year. To make the right choices for yourself, it could be a good idea to speak with your team of accountants and advisors. By being proactive in tackling this list, we're working through understanding what our client's plan design is, what their FICA wages are they eligible and going to make super or enhanced catch-up contributions, and weighing out the pros and cons of making a pre-tax versus a Roth catch-up contribution. As you may know, there was recent tax legislation put into place that has many caveats that could affect how you go about your tax planning. So today, I'm going to dive in and break down what I think are some of the most impactful policies for the most broad range of people. While this new tax bill is comprised of multiple components and has already garnered the interest of the retirement industry for a variety of reasons, I'm going to try to break down for you and simplify some of the key terms that I have found in reading through it. And here's why I think this is not only important, but also timely. Some of these key changes are set to phase out over time, with some of them ending in 2028 and some ending in 2029 as they stand currently. With that, my overall hope here is that you're going to be able to take away some useful information from this video and put it towards your tax planning in an educated manner. Let's start with one of the most overlooked pieces to this puzzle that I see, and that is the temporary expansion of the state and local tax deduction, or the SALT cap, which could potentially be useful for those retirees in higher tax states. If you own a home in a place like New York, New Jersey, or even California, this is something that I think you're going to want to pay attention to. The SALT deduction allows you to deduct state and local taxes from your federal income, such as property taxes, state income tax, and some local tax. For many years, this deduction provided meaningful relief for those particularly living in higher tax states. With this recent legislation put into place, the SALT cap was expanded from $10,000 up to $40,000 for those with a modified adjusted gross income of less than $500,000. This is a substantial increase on the cap, and depending on one's particular situation, this could have a dramatic impact on your tax planning. For example, consider a retiree who lives in suburban New York paying $22,000 in property taxes per year. Under the old cap of $10,000, only a portion of that $22,000 could be deducted annually. However, with the increase in the cap up to $40,000, now the full amount of $22,000 can be deducted. The result of this change could amount to thousands of dollars in annual savings depending on one's situation. And in my view, this is particularly relevant to retirees living on a fixed income. For every dollar saved is another dollar that you could theoretically put towards something like healthcare costs, groceries, or even just going out and having fun. Another example, if you're a couple living in the state of California and you have $15,000 in property tax and $10,000 in state income tax, you can now deduct that full $25,000 under the new cap. It is important to note, though, not everybody will qualify for the full $40,000 deduction. This extended cap starts to phase out for taxpayers with modified adjusted gross income over $500,000, being reduced by 30% of the amount over the threshold, eventually reverting back to the $10,000 cap. When it comes down to planning, something that I focus on is reviewing one's income sources, timing of withdrawals from their pre-tax account, and trying to figure out how to take full advantage of these deductions when working with their accountant. As it stands right now, this SALT deduction cap increase is only temporary, and it is set to change back to the $10,000 limit in the year 2029. And while this SALT deduction change could offer a great tax break for many, it's only one piece to the puzzle when it comes to retirees and what could help them. There's another provision, which in my opinion targets one of the biggest pain points for retirees, which is taxation on Social Security. The $6,000 senior deduction is something that could help potentially reduce or even eliminate the tax on Social Security that they pay each year. If you're age 65 or older, this bill could potentially have a great impact for your situation. And if you're married, you could deduct up to a full $12,000 annually. This $6,000 deduction per eligible individual is available whether you itemize your taxes or not, which is particularly attractive to a more broad range of retirees. For single filers, this deduction is available if your modified adjusted gross income is $75,000 or less. And for married couples, the full $12,000 deduction applies if your modified adjusted gross income is less than $150,000 per year. If your income is above these thresholds, this deduction does phase out over time depending on your income limit. To see how this plays out, let's take a look at a married couple with a modified adjusted gross income of $140,000 annually. Under the old rules, their Social Security could theoretically have been taxed up to 85% of the total value, depending on their sources of income. With this new deduction, they can now lower their income by $12,000 annually, which could substantially lower their Social Security tax liability. This change has the ability to potentially reduce taxes by thousands of dollars annually. And for those retirees that are focusing on things like healthcare expenses, cost of living in general, groceries, and other items that might be facing inflation, this could be particularly useful. Similar to the SALT cap expansion, it's important to note that this is another change in this bill that is only temporary as it stands today, phasing out in the year 2028. Next up is car loan interest, whereby this new bill allows you to deduct up to $10,000 of interest on a loan for a qualifying vehicle. To qualify, this must be a new car purchase, and the car must be fully assembled within the United States. Cars assembled outside the United States or leases don't qualify. And as with the provisions I listed earlier, income limits do come into play as far as how much of the deduction can be taken advantage of here. This deduction begins to phase out for earners that are single filers that are earning $100,000 or more. In addition, for married filers making $200,000 or more of modified adjusted gross income. In simpler terms, the phase-out decreases for those income limits I listed previously and disappears completely for single filers earning $150,000 or more, and for married filing jointly earning $250,000 or more per year. For example, a single retiree earning $100,000 a year, paying $6,000 in interest on a loan, is fully eligible for that deduction. However, if that person goes above $150,000 in income, there is no more deduction for them. And if you've been weighing the pros and cons of buying versus leasing, this could come into play for your particular situation. In focusing on the younger generation, something that I want to hit on that I haven't seen getting too much coverage is the changes that are made to the 529 plan. For anyone not aware, a 529 plan is a tax advantage plan geared towards educational spending. The recent expansion of eligible expenses for the 529 plan now includes things like homeschooling, professional credentialing, and even tutoring. And this next feature makes me very excited. As you may or may not know, I'm a major proponent of saving. Children born between the dates of January 1st, 2025 and December 31st of 2028 are now eligible for a savings account geared towards children, similar to an individual retirement account or IRA. These new accounts, set to launch in 2026, will receive an automatic $1,000 government contribution and will have $5,000 contribution limits per year. These accounts are set to be like individual retirement accounts for those under the age of 18, which have a variety of differences from current savings plans for children. And what makes these accounts particularly unique is the funding sources that are allowable. Not only can family members contribute, but employers can contribute, government sources, as well as nonprofits are also allowed to contribute money to these accounts. For example, an employer will be eligible to contribute up to $2,500 per year for a dependent of one of their employees, and this will go towards the $5,000 contribution limit, but it will not be counted as income towards the child. This feature distinguishes these type of accounts from other IRA-type vehicles, where employer contributions are usually counted towards income. Any funds contributed are essentially locked in until the child turns 18, at which point these accounts automatically convert to a traditional IRA. So from that point on, the new account then follows all the same rules as a traditional IRA as far as contribution limits and withdrawal restrictions are concerned. Also important to note that investment restrictions may be imposed on these accounts in an effort to try to protect the child from investment risk over time. Once the account converts to a traditional IRA, however, at age 18, the child has free range to invest in whichever manner they want. Let's look at how this might work in practice. A grandparent contributes $5,000 annually on behalf of their grandchild from birth up until age 18. In addition, the account receives a starter from the government of $1,000. Over the course of those 18 years, this amounts to about $91,000 in contributions and hopefully experiences growth and compounding interest over time, which could grow substantially from there. And while the exact outcome can vary for a multitude of reasons as far as the account is concerned, this could end up providing a wonderful base by the time the grandchild ends up reaching retirement age. In addition, one other thing to note, the contributions to these accounts do not affect those that are making the contributions, whether from the parents or the grandparents, if they are contributing to retirement plans of their own. This means theoretically, you could help fund your grandchild or child's future without jeopardizing your own retirement savings. And for retirees that have the means to do so, this could also be particularly attractive as it could provide another pathway to transfer wealth to the next generation. And to expand on the idea of wealth transfer, this new legislation also brought change to the federal estate tax exemption. This number was set to drop almost in half in the year 2025 to about $6 or $7 million, which as far as I'm concerned caused a bunch of scrambling happening over the past couple of years. With these changes, the new limit for individuals is now $15 million, and for married couples is $30 million when it comes to the federal estate tax exemption. Important to note here, these changes are actually permanent, and they will start to adjust upwards for inflation starting in 2026. Now, with all of these changes taking place, it could be an opportune time for you to meet with your team of trusted professionals, whether an accountant, an advisor, or even a tax attorney. And in my mind, this new tax legislation is more than just a bunch of tax changes. This presents opportunity, and I feel could be catalyst for change and reason for reviewing your plan. Being informed and remaining nimble can be positives in a changing landscape. And because eligibility and phase-outs can be complicated, meeting with your accountant and going over your plan could be beneficial for you. Today we're going to cover 2025 Medicare premiums, how a little-known factor called IRMAA could end up skyrocketing those premiums to the tune of thousands of dollars per year, in addition to what those IRMAA bracket surcharges are, and 3 strategies that you can consider when building your plan to try to avoid IRMAA altogether. My goal here is to arm you with the information to make an educated decision when you're going about your retirement planning, because all too often we find retirees are caught off guard by these additional expenses. Quite frequently, actually, when I come across these types of discussions with clients, I find that they often think that Medicare comes with one flat price tag. Essentially, you sign up, just like everybody else, and that's it, you're good to go. But unfortunately, that assumption doesn't always hold up to be true. And in fact, your premiums could end up being 2 or 3 times higher than your neighbors. And it all boils back to your reported income, nothing to do with your health. So let's break this down for a minute. In 2025, the standard Medicare B premium is $185. But with the highest IRMAA surcharges, that premium can actually escalate to about $600 a month. Same coverage, same doctor visits, nothing extra. The only thing is, if your income is higher, you can expect that you could end up paying higher premiums. To put this scale into perspective, a married couple with modified adjusted gross income above the IRMAA thresholds to the upper end of the limit could end up paying about $12,000 more than a family with income lower than the IRMAA limits per year. When you multiply that outcome over several years, it ends up becoming quite hard to ignore. And normally, Medicare Part B is subsidized, so the government ends up paying about 75% of the total cost, while the beneficiary ends up footing the bill for about 25%. But with this great thing called IRMAA, unfortunately, higher income earners have to pay more than that 25% portion of the bill. In other words, although this surcharge is framed as an additional contribution to the system, it could end up acting like some sort of a stealth tax for retirees caught off guard. Now, as I mentioned earlier, there are multiple times that we come across per year where retirees are caught off guard by this situation. It's actually estimated that between 4 and 5 million Americans are hit with IRMAA surcharges annually. And while some have planned very carefully and diligently for their taxes and investments, they might not have planned for these IRMAA surcharges as far as their withdrawals in retirement are concerned. With that, I find it very important, in my opinion, to understand this next piece of the puzzle. These potential surcharges are not necessarily based on your current income, but rather on a 2-year look back. So, for instance, your costs for 2025 would be based off of your modified adjusted gross income for the year 2023. And this 2-year look back isn't just a one-time adjustment. It occurs on a rolling basis. So your 2026 premiums will be based off your 2024 income, and your 2027 premiums will be based off your 2025 income. Now picture this. You finished out your working career in 2023, earned your full salary, and stepped into retirement in the beginning of 2024. By 2025, your income may have dropped substantially, where you have modest Social Security checks, and you're drawing just enough to keep you going from your investments. But Medicare does not care, and they still charge you based on your 2023 income. The same issue can hit if you've had a one-time spike in your income during that year 2023. Whether it occurs due to the sale of a home, or maybe the liquidation of a business, or even a large withdrawal from any pre-tax retirement accounts that occurred during that year. Any of those could potentially impact your IRMAA surcharges for 2025. Knowing that this could be the case, and understanding it, can put a real emphasis on the timing of your withdrawals and where you pull money from in retirement. Fortunately, on the flip side, it's also important to note that you aren't stuck paying these IRMAA surcharges in perpetuity if things should change for you. Medicare does allow for adjustments to be made over time if your modified adjusted gross income were to fall below those IRMAA thresholds as well. For instance, if your retirement income was cut in half, or if you experienced a life event that significantly impacted your income in some fashion, there are ways that you can challenge the numbers. So understanding how and when to respond can also potentially be helpful for you. Because in some instances, we find that retirees think that they are stuck in paying those IRMAA surcharges year after year, no matter what. And here's where the next part of the discussion comes into play. Because while the 2-year look back sets the baseline, you're actually able to provide instances and proof of where your income might have dropped dramatically, therefore potentially allowing you to pay less in those IRMAA surcharges. In the event you experience a qualifying life change that dramatically reduces your income over time, you could end up filing a Form SSA 44, whereby you're requesting that Social Security recalculates your premiums. And although not every event qualifies, Social Security does recognize a certain set of events, which could include things like divorce, death of a spouse, significant decrease in work and the ability to earn income, or even the loss of a property producing income. These are all sets of circumstances where your financial picture might have materially changed, and the system could allow for recalculation. And be prepared, more than likely you're going to have to gather documentation if you choose to go this route. This could include things like an employer's retirement letter, a pension settlement, in the case of a spouse passing, a death certificate, or even a signed and amended tax return. Social Security needs verification that one of these qualifying instances actually did occur and your income decreased as a result. Without evidence, the system can default to assuming your old level of income, which could include those IRMAA surcharges. And while this appeal process could potentially take some of the sting out of this situation if you do get hit with these IRMAA surcharges, let's explore some of the steps you can take to be proactive in trying to avoid them altogether. One of the main factors we consider when planning for clients is trying to design their retirement income flows in a way that keeps their modified adjusted gross income below the IRMAA thresholds if possible. In a broad sense, I focus on 3 specific categories. The first of which being Roth conversions, whereby you convert pre-tax dollars to Roth accounts, paying tax in the immediate in an effort to potentially reduce income down the road. And while the conversion itself counts as income in the year that it occurs, there is the potential to lower those pre-tax balances going out into the future in comparison to what they could have been otherwise. And if we're deciding to implement these conversions over time, something that we do look at as far as dollars and cents are concerned is the potential benefit to one by creating these Roth conversions as opposed to the IRMAA surcharges or potential for IRMAA surcharges that they might face. The second tool to consider is a qualified charitable distribution, or a QCD. For folks age 70 and a half or over, this allows you to send a portion of your retirement withdrawals from pre-tax accounts to a qualified charity. And if you're of the age where you're currently taking required minimum distributions, these QCDs can count towards the RMDs for that current year. For 2025, that number is $108,000 per person, and that would not be added to your modified adjusted gross income. To illustrate this, let's say this year, in 2025, I am 75 years old and I have an RMD of $70,000. Rather than taking that money out and adding it to my modified adjusted gross income for the year, I choose to make a qualified charitable distribution of $70,000, whereby I donate the money, it does not get added towards my income, and hopefully I can skirt by and stay under those IRMAA thresholds. The third tool we use is understanding when and where we are going to take certain withdrawals from in retirement, in addition to when we are going to establish Social Security by intention as opposed to by default. In some cases, planning which accounts you're going to take money from first in retirement can have a direct impact on your tax situation. For example, making withdrawals from non-retirement oriented accounts or smaller withdrawals from pre-tax IRA or 401k type accounts could end up resulting in a less volatile modified adjusted gross income over the course of time. Similarly, delaying or accelerating when to take Social Security could also end up making a difference as to when those taxable benefits hit your bottom line. Precision here can be imperative because the IRMAA brackets operate like cliffs as opposed to gradual slopes. $1 under the threshold and you can stay at the base premium. $1 over the threshold and now you have a bump up in cost. I like to think about sequencing income as more of a rhythm as opposed to a one-time event. In some cases, we find retirees opt to take money first from their non-retirement accounts in an effort to keep their taxable income lower, and then end up taking money from their pre-tax accounts down the road when the Medicare situation might be more predictable for them. Alternatively, some retirees might choose to map out Roth conversions between the year they retire and before they hit Medicare age in an effort not to collide with those IRMAA cliffs. The common theme between these two situations is that they are coordinated, intentional choices, not just following things as they go. And the broader point here is that these surcharges can potentially provide a sense of predictability. A positive here is that the brackets are published in advance. And while everything can change over time, working with a team of trusted professionals could give you a shot in making more informed decisions. And in my opinion, this is where the bigger realization begins. Our approach to retirement isn't just about tax efficiency or portfolio growth. Each decision can tie into another. So it's important to understand how these situations and choices could potentially intertwine in addition to what the ramifications could be of said choices. When working through the planning process and considering things like Roth conversions, qualified charitable distributions, or even income planning in general, it's important to understand that everybody's situation is different. And while investment returns and markets in general can be unpredictable at times, understanding things like tax planning, healthcare and Medicaid planning, and even estate planning reviews are all pieces to the puzzle that we go over with our clients. Rather than looking at retirement as one snapshot in time, we look at it as a journey that presents all sorts of twists and turns. And if you're unsure what this could mean for you, don't hesitate to reach out to our team. We've helped hundreds of families plan for retirement through the course of the last 10 years, and we pride ourselves on being part of their big picture. Do not retire before you pay off your mortgage. This is not my advice in any way, shape, or form, but rather one of the most common thought processes that I've come across over the last 12 years working with clients. Do you know the biggest mistake that I see pre-retirees make when trying to make the decision between paying off their mortgage before retirement versus investing? It's not always what you might expect, especially for those that fall into the age range between 50 and 65 years old and have a prime focus on their financial future. And although the decision can feel simple, become debt-free and live a simple life, it can be far more complex than that. Today, I'm going to show you why the situation is not always clean-cut and black and white, in addition to the steps that I use with clients to help them work through their specific decisions. So let's take a closer look at what's really at stake here. For many people I speak to, as they approach retirement, the feeling and thought of being debt-free is something that is extremely desirable in most cases. Many times, they have a feeling or a mindset that paying off your mortgage and having no debt provides financial stability, and that is what you should be aiming for as you get closer to the finish line. No more monthly payments, no more debt hanging over your head. It kind of does sound like that could be a really nice way to enter the next chapter in life. And while the emotional relief could feel comforting, there could be a cost associated as well, in potentially missing out on any compounding growth that you could have investing over time. When you focus on putting every dollar that you have towards your mortgage, you're essentially tying that money up in an illiquid asset, as opposed to keeping that money free-flowing and liquid and potentially investing in the markets. Now picture this. You reach retirement, you're completely debt-free, and then an unexpected expense comes up, leaving you scrambling for liquidity as you tied up all of your money in trying to turbocharge those mortgage payments. In some cases, this could leave one scrambling for money, not knowing what to do, potentially having to take out a loan, or even selling investments at an inopportune time to create the needed cash. And this is where the concept of opportunity cost comes into play. Every time you take that extra money and you put it towards your mortgage, it comes with a trade-off. So let's put this into perspective. Over time, historically speaking, the S&P 500 has achieved a rate of return of about 8 to 10% annually, while mortgages in recent years fall somewhere between a 3% to 5% rate of interest. If your mortgage interest is at the lower end of that range, let's look at things through this lens. Consider the return, quote unquote, that you receive for paying that mortgage off early. If your mortgage is around 4%, that could be the rate of return that you're achieving on that money annually. But if you invest that same money in the stock market over time, theoretically, you could be achieving a compounded rate of return between 8 to 10%. A caveat that I find of importance to bring up is having the realization that that feeling of being debt-free is not just a rational calculation, but it also can be a very emotional decision as well. Knowing that your home is fully paid off could bring one a feeling of confidence and safety, which is very hard to ignore in the instances that I've seen personally. But the fact that you're locking that money up in an illiquid asset is something that I find also important to consider and something I cannot turn a blind eye to. The next factor I'd like to take into consideration is understanding how that interest rate attached to your mortgage could potentially influence your financial situation moving forward as you approach retirement. This single figure can be very important in having an understanding of which decision you should make. Should you be choosing to accelerate your efforts in eliminating debt, or should you be investing that money? As I stated earlier, if you have a low rate, around 3 to 4%, there could be a compelling case to say, hey, maybe you should invest this money instead. While markets can fluctuate, and there are certainly never any guarantees, let's just say, for instance, I have a 4% mortgage. Every dollar that I put towards that 4% mortgage saves me $4,000 for every $100,000 of debt per year. When compared to the compounding potential of the stock market, looking at a number between 8 to 10%, that same $100,000 could be gaining $8,000 to $10,000 annually. And I will say, as always, it's very important to take into account other pieces to the puzzle, such as fees, taxes, and your personal situation. Now let's take a look at the other side of things. Say your mortgage rate is 6% or higher. In this situation, paying down that mortgage quicker could save you 6%, which could equate to $6,000 per $100,000 per year. And when the interest that you're paying on the debt has the potential to rival or even exceed the expected returns that you could be earning in the stock market, it makes for quite a case to accelerate those payments and pay down the debt first. And being aware that investment returns are not guaranteed, markets can go through cycles and fluctuations can happen, we need to keep in mind that downturns are par for the course. So when I walk through this process, in addition to the factors that I mentioned earlier, I'm also taking into account one's risk tolerance as well as their time horizon. For someone uncomfortable with the potential for market swings or who might be closer to retirement, they may prefer accelerating their payments to get that mortgage down as opposed to taking the chance and the perceived risk that comes with investing the money. While for others, especially those who have a longer time horizon or who have built up a substantial nest egg, carrying a low-rate mortgage might be more comfortable to them. One of the biggest factors when it comes to my preference in making the decision is having flexibility. If I have investments that provide liquidity, which I can access in the event of emergency, or if I just simply need the funds, that could be more appealing to someone like me as opposed to locking my money up in an illiquid asset such as a home. Although not a perfect roadmap every time, I do think that there is reason to consider comparing your mortgage rate versus your expected rate of return in the markets as a great framework and starting point of how to make this decision. And as I build out my framework, there's another step that I feel sometimes is overlooked. The timing of my payments, whether I'm earlier on in the mortgage or in the later part of the life of the loan, could have significant implications on the benefit to me, whether it makes most sense to pay that mortgage down in rapid fashion or invest the money. And why does this matter, you might ask? Because mortgages are structured around a process called amortization, where a portion of that money goes towards principal and a portion goes towards interest. In the earlier years of a 30-year mortgage, the majority of that money that you're making as far as a payment is concerned is going towards paying down the interest, and a smaller portion is going towards paying down the principal. And over time, this ratio typically shifts, whereas towards the later part of the loan, you're paying down a larger portion of principal and a smaller portion of your payment is going towards that interest. In other words, simply looking at things, if you're accelerating your payments in the earlier portion of the loan, you could be really denting that amount of interest that you have to pay over time. By year 20, however, that same payment might only save a fraction of what it was saving you years earlier. For me, the bottom line is, as this impact and potential savings shifts over time, so does my thought process in how much I should invest versus how much I should be putting towards the mortgage. It's also important to read the fine print on your mortgage, as in some cases there are prepayment penalties associated with these loans, whereby you could be getting charged extra fees for making extra payments. And although this decision might seem like a major fork in the road, I like to relax and think it doesn't have to be that way. You don't have to make one choice at the expense of the other. You might find comfort in a more balanced approach, whereby you end up splitting those extra resources between paying off the mortgage and building wealth simultaneously. An example might look something like whether you receive an inheritance, or a bonus at work, or a raise, you use those extra funds and you split a portion to go towards paying off the mortgage in an added accelerated fashion, in addition to putting some of that money into your investment account. This method can help you not only pay down that mortgage in an accelerated fashion, but also help you potentially grow your investments over time, and most importantly, potentially eliminate the thought of regret in making one decision over the other. Another tactic to consider is making bi-weekly mortgage payments rather than monthly payments. So at the end of the day, the result here is you could end up making a full extra payment throughout the course of the year. Over the life of the mortgage, by doing this, you have the ability to potentially cut down the life of the loan significantly and end up saving a significant portion of money. At the same time, continuously adding money to your investment account could allow that wealth to grow over time and have the potential for compounding returns. For me, I find comfort in understanding that I have a solid financial foundation prior to splitting up any additional monies in either direction. Eliminating high interest debts, things like credit cards or personal loans, is key in my mind, in addition to making sure I have some sort of an emergency fund which is flush with cash. I personally choose to automate my savings so I don't have to think twice, and I know that the money is being divided up as to how I want it to be. And this approach isn't just strictly about numbers. It's about flexibility and peace of mind for me. While the markets as well as my personal situation could change, having this flexibility brings me confidence as I charge forward in making decisions. Because as I've seen time and time again, although some folks might feel uneasy about carrying a mortgage into retirement, they might also have a feeling of missing out on potential growth in future years. So I maintain the mindset that these financial decisions do not have to solely be made inside a vacuum. Even with a plan in place, emotions can end up coming into play and influencing how money is managed over time. The desire for security, the fear of missing out, and the potential comfort of being debt-free can all play a factor and a role in making the decisions that we make, which at the end of the day might not be completely rational. So recognizing how emotions might interact with financial decisions could end up helping you better align yourself with your goals. And while there might be the satisfaction of knowing that you've eliminated your mortgage, you have no more monthly payments, and this is the culmination of all of your years of hard work, becoming fully immersed in those feelings and mindset could potentially lead us astray and not bring us to maximize our full potential over time. An interesting example of this comes from financial writer Morgan Housel, who states in one of his writings that paying off his mortgage early was one of the dumbest things he has ever done. But he also stated that for he and his spouse, making this decision brought him a feeling of independence and confidence that far outweighed the potential for the gains that they might be leaving on the table otherwise. Their story illustrates how emotional comfort could outweigh objective analysis, even for those who know how to crunch the numbers. And although, depending on your calculations and how those numbers pan out, at the end of the day, by leaving this money on the table, you could end up missing out on significant returns and potential compounded growth years into the future. With that, regardless of the numbers, for those in a similar position or mindset of Morgan Housel, the ability to go to sleep at night, lay your head down, and know that you're debt-free and you can live in comfort might far outweigh any spreadsheet calculations. When weighing the decision in whether to pay down the mortgage in an accelerated fashion or invest the money, here's the 3 simple steps I follow. First, I compare the rate of interest on the mortgage to my expected returns from my investments. Second, I consider where I'm at in my mortgage term and how much liquidity I might need in the event of an emergency. And third, I try to find a balance of risk versus return and feeling of comfort in paying down my mortgage versus investing and how that aligns with my personal goals. As always, I find it helpful to work with a team of trusted professionals to help you come up with the best answer for you. Today I'm going to break down for you one of the most common things that I hear clients say that they wish they handled differently with regards to their paycheck through the course of their career, in addition to the exact 4-step system that I use every payday. This system has not only helped me build my wealth and focus on preservation and generating a legacy over time, in addition, it's helped me automate things and make my life a little bit more smooth. Here's the brutal truth. All too often, I see folks using their paychecks somewhat like a checking account, where they spend money after they get paid and eventually hope to use what's left over and potentially save for their future. But what if your paycheck could work like a systematic machine in an effort to help you work towards your goals in retirement? I've seen countless families throughout the years who I would consider to be very intelligent, hardworking individuals who end up having regrets as retirement nears. They've been contributing to their 401k or 403b throughout the course of their career, following the conventional wisdom as they thought they were supposed to, only to end up feeling sick to their stomachs when they end up crunching the numbers as retirement approaches. But here's what I've discovered that changed everything for me. I stopped looking at my paycheck as money to spend and shifted my mindset to looking at it as an engine for growth for the future. And this shift was much deeper than a basic budgeting plan. This was an understanding that every dollar that came into my bank account had a job, and some jobs paid better than others. When I made this mindset shift, something incredible happened for me. Rather than feeling overwhelmed by having to make every financial decision one by one, I started to notice patterns and seeing how different changes could affect other outcomes going forward. And that's when I developed my 4-step system. So when my paycheck hits my account, these are the exact things that I do. Step 1, make sure that I'm immediately contributing enough to take full advantage of my employer retirement match. In understanding the shocking statistic that about 25% of people that are employed do not contribute enough to take advantage of their employer match to the full extent, I knew that I did not want to be part of the stat. And here's why I choose to make that step 1 rather than step 4, which might be a little more common. By prioritizing the 401k match first, I can ensure that I'm getting every bang for my buck. And in the instance here, I contribute 5% of my paycheck to my 401k, and my employer matches 4% of that amount, for a total contribution on a biweekly basis of 9%. Let me give you an example using dollars and cents here. If I make $100,000 a year, and I contribute 5% of my pay, that's $5,000. My employer match is 4% of that pay, which is $4,000, which accumulates to a total of $9,000 of contributions throughout the year. Over the course of a 25-year period, assuming a rate of return of about 7%, that employer match can grow to about $250,000 alone. But here's the psychological win that I experienced by having this set up automatically. By contributing in my paycheck before it even hits my bank account, I have this money saved up before I can see it and spend it on something. Now, while many might stop here, let's take things a step further. Step 2 in the process is taking a portion and saving it in a non-retirement oriented investment account, which I call my flexible wealth bucket. And while I have total empathy for those and understand that it might not be too easy to save above and beyond the 401k contribution, I can't stress enough how much this factor in step 2 has helped me personally over the years. This also required a mindset shift. However, having an understanding that the 401k contributions that I was making was geared towards retirement was great. In addition to that, understanding that life can throw curveballs or opportunities at any time let me know that I need to save money in a different way as well. I started to wonder about other things, like what if I wanted to purchase a home, or purchase a business, or potentially take advantage of other investment opportunities over time. By taking advantage and saving in a non-retirement oriented investment account, or that flexible wealth bucket, I would build up wealth that I could use for those opportunities if they were presented to me. In addition, that money grows outside tax-deferred accounts, which means it's accessible at any point in time prior to the age of 59 and a half. And here's another kicker: the potential for tax advantages in using an account like this. When you invest in a taxable account, which again is a non-retirement oriented account, and you hold investments for greater than a year, any gains that you realize from the sale of an investment that has been held for longer than 12 months is taxed at capital gains rate, which could be lower than your ordinary income rate. For some people, that number falls somewhere in the threshold of about 15 to 20% as far as capital gains are concerned, as opposed to ordinary income, which could end up landing somewhere between 22%, 24%, or even higher. Suppose you're in the 24% federal tax bracket and you have $50,000 in investment gains. If you were to withdraw that $50,000 from a traditional pre-tax retirement account prior to the age of 59 and a half, not only would you get hit at a tax rate of 24% with your ordinary income, in addition, you'd face a 10% penalty, bringing that number up to 34% or $17,000 of the $50,000 withdrawal. However, if that $50,000 gain is inside a non-retirement oriented taxable account, you could think of it as a capital gains tax of 15% or $7,500 as opposed to the $17,000 coming out of a pre-tax retirement account. All in, that's a $9,500 difference. And be aware, there are also potential for state taxes as well as high income that could alter these numbers. Step 3, is where I pay off any outstanding credit card debt. And you might be wondering, why is this step 3 as opposed to step 1? In my particular situation, I've already paid myself first in multiple instances via the 401k contribution in addition to my contribution to my non-retirement taxable investment account. The money from my credit card payments is what's left over after I've checked the boxes for my personal savings dedicated towards my future. In addition, it also helps create a psychological constraint for me in not allowing lifestyle inflation. And I do want to be clear that my credit card covers all of my non-discretionary spending and I pay it off in full every pay period. This includes things like my groceries, my gas, and my utilities. Many times, you might see people hit this in the reverse order, where they'll pay off all of their expenses in addition to making the minimum payments on their credit cards and then try to save what's left over after. The problem I personally encountered with that strategy is that somehow, some way, the money always finds a way to leave my bank account before I can end up prioritizing my savings. In following the strategy the way I do in implementing those steps, I live within the constraints that I set on myself, and again, I don't allow my lifestyle to creep to higher expenses. I do want to be very clear on one fact here, and that is that I personally pay off my credit cards to a zero balance each pay period, and that is non-negotiable for me. One of the main reasons for this thought is that typically you can see credit cards carrying an elevated rate of interest, somewhere between 18 to 24%. With that, if I'm carrying a balance on those credit cards, there's a chance that I'm paying more in interest than my investments are earning. Consider this. If I have about $5,000 in credit card debt at about a 22% rate of interest per year, and I make the minimum payments, which tends to be about 2% of that number, or about $25, I could end up paying all in with interest about $11,000 over the course of time, and it could end up taking about 35 years to do so. On the other hand, if I had invested that $5,000 at a 7% rate of return over the course of that same 35 years, I could end up in a resulting balance of $53,000, excluding any taxes and fees. That's a difference of about $64,000 over that period of time. And here's step 4. Everything left over is up for discretionary spending on things that I consider to be fun. And here's where it all comes together. By the time I've reached step 4, I've already made my contribution to my 401k. I've taken full advantage of my employer match. I've contributed to my non-retirement oriented investment account, and I've paid off all my high interest debt. And at the end of the day, anything left over is mine to spend guilt-free. And while some might consider this step minute, for me psychologically it has a major impact. By the time I get to that discretionary spending for my lifestyle, I can confidently say that I have intentionally put away money geared towards my future and my goals. In fact, another interesting situation is when I finally understood how much I really need to spend and had left over for discretionary spending, I was able to be a lot more intentional about how I spent that money and time. When I was finally able to put all these steps in place together, I really had a great understanding of the power of compounding and how it could affect my lifestyle as well as my future. Assuming I'm earning $100,000 a year, my contribution to my 401k plus my employer match is a total of $9,000 in savings per year. In addition to that, by contributing about $500 a month to my non-retirement investment account, that's an additional $6,000 in savings per year. If I assume a 7% rate of return over the course of a 25-year period, my 401k balance could end up at about $550,000. My non-retirement investment account could end up at about $366,000 for a total sum of investment accounts of about $916,000 in that 25-year span. This doesn't include any potential for raises or any additional injection of savings over that course of time. In addition, I end up with zero high-interest credit card debt, and I'm able to live life on my terms. One of the main reasons this strategy has been so impactful for me is due to behavioral psychology. While many strategies might rely solely on willpower and discipline, I wanted to implement strategies that could eliminate as many variables and streamline my life as best as possible. For steps 1 and 2, they're fully automated. I don't even think about them and I don't see the money hit my bank account. Step 3, as I mentioned earlier, is somewhat of a force constraint that again contains my spending and disallows any type of lifestyle creep. And step 4 finally allows me to enjoy my money that's left over guilt-free, which does help make this strategy sustainable in my case over the long haul. And for me, where the most powerful part of this situation comes to play is that I've aligned these automated savings and tactics with my long-term goals. After doing this for an extended period of time, I've been able to see exactly how I save and spend money, and that has allowed me to live life intentionally. And although this could sound great, there is a question that comes to mind which we have heard on many instances before, and that is, what happens if my lifestyle changes? And what brought me comfort in thinking and reflecting on this myself is that understanding that these strategies are flexible. If I made more money, for instance, and got a raise, I could increase my contributions in steps 1 and 2, while still maintaining my constraints in steps 3 and 4 and living a comfortable lifestyle. If I have a financial emergency, for instance, I have the flexible wealth bucket that I built up in step 2 that I can take advantage of and utilize if need be. In the event that my expenses decrease, which could be something like paying off a mortgage, I could then increase my contributions to steps 1 and 2. The system adapts to my life here, instead of my life having to adapt to a rigid budgeting schedule. And let me share one more tidbit with you that I have found very important when trying to figure out the best system for me. In my case, trying to master and figure out the ideal percentages to contribute as opposed to figuring out and understanding the process led to procrastination. Spending time doing things like debating whether I should be contributing 15% or 18% to step 1, or should I be making a $500 or $1,000 per month contribution to step 2, led to me wasting time. Along my journey, I realized that perfect is the enemy of good. And moving forward, one step ahead of the other, and making the changes that I needed to in getting started, allowed me to have a greater impact than understanding what those perfect rates of contribution actually were. Keeping in mind the importance that I can change the contribution rates at any point in time. However, actual time is something that I cannot get back. In starting with amounts that I would now consider to be small as I started years back, I was able to put a plan in place and take the first steps forward. My 4-step system is not just about money. It's about making my money work for me in addition to setting up a systematic plan for my future. It's about reaching my 50s and giving myself the opportunity to have options as opposed to obligations. And it's about knowing that I have a plan in place that I have set forward in an intentional manner to allow me to sleep better at night.